Hey, this is Bubble Analytics, and this week we're going to have a look at a really good, effective, simple momentum strategy. So, momentum, it's a rate of change we're tracking. Effectively, it's how far and how fast a price has changed over a certain period of time. So in our case, we're going to be looking at the close today minus or divided by the close 5 days ago. And that is going to create our little momentum graph that we see below, with positive values telling you that price has risen over a 5-day rolling period and negative values showing that price has fallen over that period. So for our buy signals, we're going to look at extreme events, which we're going to class here this time as momentum below -5. So price has dipped 5% over that 5-day rolling period. And then for positive momentum, we're going to class that as when price was trading below zero, or momentum was trading below zero, and has now moved back above that line. So we're looking for deep negative readings to mark extreme price events and lows to buy. And also we're looking to find areas where momentum has turned positive, which suggest bullish outcomes ahead. So if you are ready to start coding that up, please read the disclaimer. Okay, let's get into it then. So I've opened up a fresh Jupyter notebook. I've renamed it Momentum here, and I'm just going to click in the first cell, hit Shift Return a few times to create some empty cells. To save time, we'll be pasting as usual from our template here. It just contains repeatable code snippets that we use each time to create a strategy and backtest it. So the completed codebook and the template will be available to download for free via our website. The link is in the footer here. It's through our GitHub profile, so you can get the template and the codebook for each of the strategies that we put on our YouTube channel. So let's get going then. So as usual, first job is always to import out libraries. So I'm going to take all of that code block here and paste that in there and hit Shift Return to initialize them. These contain libraries with pre-built functionality that we're going to make use of when we create our strategy and then backtest it. So next job would be to download some price data. I'm going to take all of that code snippet here, paste that in there and hit Shift Return to run it. And this is the output. If you notice here, actually, it doesn't always happen. I'm recording this on a Saturday. I normally do it on a Sunday. But for now, Yahoo, for whatever reason, doesn't have the latest data on Friday. So you get none values in that column there. We're going to tidy that up in a minute. But the key line for this particular code snippet is the one at the top. Let me just comment this out and run it again. Shift Return to run. And you can see this is what the data comes, or this is what it outputs in raw format. So, and then these lines just tidied up. So effectively all we're doing here is telling it to use the Y Finance library, so Yahoo Finance, which we imported here and named YF. And then we're going to use that download method to take some historical market price data. So you need to give it a minimum of 3 parameters. There are others, but the minimum, you need to tell it the ticker, the period of time you want the data for, and the time frame. So in our case, what we're telling it to do is download 10 years worth of daily time frame data for QQQ, the Nasdaq 100 ETF. As we say most weeks, if you can get your strategy to work after paying fees and with no leverage on QQQ, you're going to find a ton of stocks that you can apply this one to. The data that we download here, we're going to store in a variable called DF. So whenever you see DF, stands for data frame, that is referencing the price data. So all of these other lines here just tidy this up. So if you notice, we've got some superfluous header column names here. So we're going to get rid of that. So first job would be to flatten the columns a little bit. So get rid of the bits that we don't need. And then what we're going to do is separate price and date into their own columns. So we're going to make price the index by resetting the index here. So if I run that line, price is now the index with the row number is the index. So, and then for our date, even though it looks like a date, when it comes through, it's actually a number string. And if you want to actually use it as a date format, as we will be doing when we show the date, the month and the year on our x-axis later, you need to convert that to a datetime format. So that line there uses the pandas library, which we imported here as PD, and then using their toDateTime method to convert the date column into a datetime format. And then finally, we don't need the volume for this strategy, so I'm just going to delete that. So tell it to delete the volume column within DF. And then finally, Like I said before, I don't know why on a Saturday, well, you're starting to see this a bit more, but basically at present, Yahoo hasn't updated the OHLC data for Friday. So I'm just going to tidy that up by dropping the NAs. So df.drop NA in place equals true just means do it on the existing data frame and drop the NaN values. So if I run that now, that's our data in the format that we can easy to read, and yeah, so we're ready to go. So what we're going to be creating today is a strategy just around momentum. It's really basic, really simple, but very, very effective. So it's basically the rate of change, which I've just called momentum here because I think it's, I don't know, I think it's easy to understand, but effectively, all it's looking at is the percent change over a certain period of time. So this is what the line looks like. And you can see that stock charts here have added some sort of levels line to point out when an extreme event has occurred, but they're using the 12 period rate of change. So they're looking at the percent change over a 12 period. And the formula to do it is here, but actually, we can improve upon that a little bit. So they have the close today minus the close n periods ago, 12 in their indicator calculation here. But so it's the close today minus the close n periods ago divided by the close n periods ago and then times 100. So, but we can do that a little bit easier. So what I'm going to do is create a new column within DF called momentum. So, and that is basically going to be equal to our close today divided by our close 5 days ago. And to do that, we're going to use the shift method. It just shifts the rows up by 5. So effectively, we're taking the close today divided by the close 5 days ago minus 1 and then times by 100. And that's algebraically identical to the rate of change formula, really. So, and if I just run that and then run our variable df to have a look, we should see now we've got our momentum column here. So that's the first thing. I'm going to get rid of the NaN values there as well, just in case the backtesting library has a little connection when we run it. So now we've got no NaN values, and effectively we're starting at row number 5 because that's the first point. We've got 5 values to be able to run this particular line here. So all it's telling you is what the percentage move was over a rolling 5-day period. So Monday to next Tuesday, Thursday to next Wednesday, that kind of thing. So yeah, that's it. Done. And let's get it on a chart then. So let's do that bit next. So what I'm going to do is pull in all of this data here. So all the top section. And I'm going to leave a little bit of a gap there and then just muck around with this a little bit. So always reset the index, do that on the, or set the index, do that on the line above. Otherwise Plotly can throw a little error when you try and rerun it. And then what we are saying here is create a variable called fig into which we're going to store all of our chart settings. So wherever you see fig is basically everything that we're putting into this chart to render it. And then what we're going to do is make a subplot with 2 rows in 1 column. So if we come back to stock charts here, this is all 1 column with 2 rows, price data on row 1, indicator data on row 2. So and so we're creating 2 rows, 1 column, sharing the x-axis, and then this just defines how much of the screen real estate or the chart real estate row 1 gets versus row 2. And then this section here, we are adding a trace into our fig variable here, telling Plotly to use the candlesticks method in order to pull in the OHLC data from our DF data frame. And then this sets the green bars versus red bars. You can change the colors here and then give it a label, and then we're telling it to put that data in row 1. So that's price. Let us go and grab some indicator data, and so that's this line here. So add indicator data to our indicator subplot. And then for this, all we need to tell it basically is where to find the data that we want to display. So we put it in a column named momentum. So we just need to tell it to pop that in there. And then obviously you can give it a label. And what have I done here? No. momentum, right? And then we're telling it to put it in row 2. And then for the color, obviously you can change it to whatever you like. In fact, I'm going to use our, where will I have it? Yeah, let's use that. This is bubble green. I like this. It's pretty. So we'll whack that in here like that. And then finally come back to our template then. And we want all of the stuff probably up to here actually. So, and all the stuff at the bottom is just styling up your chart. So we are telling it to use a dark theme, set the chart width 1100, height 700, update the grid colors so they're less garish. And then this part here is important. So when Plotly renders data on a chart, it doesn't understand that we don't have any price data for Saturday and Sunday. So what we're going to do is update the x-axis, which is where we have our date and our month and year, and we're going to create a range break that starts on Saturday and ends by Monday, so basically excluding Saturday and Sunday data, just to get rid of the gaps that would appear if you didn't have that line in. So, and then we're not going to save our chart image. Oh, and this sets a horizontal line on the chart, a bit like stock charts did here. They added some red lines here to show you sort of extremes. We're going to do the same thing by adding a H line, a horizontal line, which is going to be in row 2 for our indicator data, and is going to be a 0.5 line width gray line, basically. So let me just copy that a few times because we're going to add a few onto our chart. Okay, and then I'm going to have these 10, 5, -5 and -10, right? So if I run everything again, and fingers crossed I haven't made any mistakes, there we go. Oh no, something weird has happened. Oh, we're showing the data right at the very start. So if you notice that we're starting here in August 2016, let's go and change that a little bit. So this bar sort of splicer here, all it's doing is giving you the ability to show a certain number of bars from a certain point. So this is the starting point bar here, and you can see we've got 2,508 rows of data. Currently we're starting at row 0 and displaying the first 200. I'm going to change that to 500, and then we'll start at, what's that, 20,010. Yeah, there you go. And then run that again, and now we've got more data here. So, and actually to make that a bit better, I'm going to change the line width on our indicator data just to make it stand out a bit more. There we go. So now you can see we've got horizontal lines here on our new momentum indicator. -10 seems to be a real extreme. That's why I wanted to show more recent data, because a very quick savage drop where price drops sort of more than 10% over a 5-day period is something that you might want to have a look at for, a point to buy in at the market. But in general, within uptrends, you don't really get much of a savage drop, or, it seems to sort of hover around the 3% is your normal sort of pullback area. So useful information there. But anytime you get sort of below 5% over a rolling 5-day period, that potentially could mark a low. So you're probably going to get them there and there. And then you definitely got them on this pullback, and probably got one here as well. So that's the first thing we're going to look at today, is trying to pick out extreme lows. So let us go back into our template, and then what we're going to do is pull in the functions that allow us to do that. So let me come in here and do this one first, and then what I'll do is also grab all this, and we'll pop that in there. All right, so first thing we're going to do is have a look for periods where the QQQ drops 5% or more over a 5-day rolling period. So basically what we're looking for is values in our momentum column that are -5. So really simple. So, and then where we see that, we're going to put a 1 in our signal column. So this function, all it does is it runs a loop over our data, our price data, looking for our buy and sell parameters to be hit. So the key line is this one for I in range. That's telling it to run a loop, starting at row 2, and then for the full length of our data, and then it's just going to run through line by line, looking for whatever our parameters are, and where it sees them, it's going to put a 1 in a signal column, which we're creating here. So where you see I is the current row it's looking at. I-1 would be yesterday's row, I-2, 2 days before current, so on and so forth. So in our case, they're really simple. All we're looking for is values in our momentum column. So .iloc I, which is today's value. So if today's value of momentum is less than -5, we're going to put a 1 in our signal column. And what I'll do, I think, is just comment that out for the time being. And we're going to treat these as our long entries. In fact, I'm going to rename it oversold entries because we're going to have more than one in a minute. So we're going to call that oversold entries, right? So this is where we've had a big sharp pullback over a short period of time. So oversold entries, and then I need to change that there as well. And then, so what this function's doing is it's looking through our signal column, looking for a 1, and where it sees a 1, it returns the value in the low column minus a small offset, and it creates a column within our data frame called oversold entries, and records the price wherever we've seen that 1 in our signal column. And then what we need to do to put that on the chart, we need to come back into our chart settings here. I'm just going to start with this for the time being. So, and we're going to have to amend it very slightly, but this little function here, all it does is look in this new oversold entries column here, and where it sees a price, it's going to create a marker, which in our case is going to be a white arrow up, size 7. So I need to change this to oversold entries. So again, a short, sharp pullback over a short period of time is what we're looking for here. And we're basically going to play with the -5 figure. So obviously you can muck around with that to try and pick out good times to go along. So you can see it marked the lows here, so seemingly very good. And you did get a couple of little false signals here and here, but in general, it seems, that you're going to get one right at the lows, even if you got one a bit early here and a bit early here, so obviously not perfect, but also marked the low here, and the very recent low. So, in general, not bad. And obviously it's obviously an extreme event and a good place to mark lows. But if we were just to run this, and in fact, I think I will, just so we can get the back testing script ready. But if we were to run this on its own, I don't think we're going to find that we've got enough values. In fact, we can check that up here. So this line here is looking in the signal column and giving us the value counts. So it's got 91 buy signals. Actually not that bad. I thought we'd have less. So, and obviously you could play with this. So you could change that to 8% and run it all again. I won't, just to save time, but that's something that you could do. So we will leave that as it is then. So we've got 91 of those buy signals, actually more than I thought actually, but we'll see anyway. Let's run a backtest. So I'm going to get rid of, so I've imported, or I've pasted all of my backtesting scripts into the code book. And I don't need this block because we are not going to sell over after a certain period of time. And we're not going to trade on the close. We trade on the open following a buy or sell signal. And we're never going to hedge because exclusive orders is true, meaning we can only have one position open at any one time. We are going to pay a fee equivalent to 0.05% of whatever amount is invested into the trade. And we do that when we open the long and then close the long. So it's a 0.1% total. So on 100 grand, it's quite a lot in fees. Margin at 1 just means no leverage is used in the strategy. And we're going to start with a cash value of 100 grand. Just going to comment that out, this line or this block out for the time being, because we only have 1s in our signal column for now. So if I run this in raw format, in fact, let me just run everything. But if I run this now without adding any kind of sell signal, you only get one trade. In fact, it's not even closed yet. So the first time you got a buy signal here, it's just holding long. And that's because you've never told it when to get out. So in our case, you could do that by adding a stop or a profit target. But in our case, we're just going to do a profit target. So to do that, I'm going to tell it our take profit or TP here is equal to 1.02 times the price at the close of a buy signal. So we're basing it from there. So TP is 1.02 times price, so 2% above the price at the close where the buy signal came. And if we run that again, you can see you're in the market very rarely, so 10%, 11% of the time. It still makes you a little bit of a profit, 104%. Drawdown's actually worse than I thought it would be, 24% nearly, 44 trades, and the win rate is 88%. So the drawdown's so large there, and the number of trades versus number of actual signals is low because you're holding on, so you don't have anything that gets you out. So say, for example, this buy signal here, you would be holding that until probably this point here, where it got you out for a 2% gain. So if you were to play with this strategy, you definitely would want to be having a look at adding a stop in here. I'm not going to do that today just because, well, I can't be bothered. But you definitely should be looking at that. But obviously, with the strategy, we don't really have enough buy signals. So that's the one big problem, is that, you know, when you're waiting for an extreme low, they're quite rare. So, you know, a 20% drop in the market is what, once a year, you know. So if you're waiting for those periods to occur, you're not going to be trading very often. So there's two ways to use momentum. Obviously, negative momentum that we've looked at already, but positive momentum as well. So what we're going to do is look for periods where momentum was negative and then turned positive. So what we're saying there is we're looking for periods where price has pulled back. So 5 day rolling momentum has now turned negative. So we've made a loss over a 5 day rolling period, and then starts to turn higher. And so we're looking at to pick out points where we've turned lower and then started to turn back up. And then, so to do that, straightforward, all we're going to be looking at is times where the momentum line was negative and then moved above zero, so turned positive. So straightforward, and then we're going to create another data point. We'll keep it as 2. Normally I use that for sell signals, but in this case, we're going to have this as our new type of long. So if I take the value in my momentum column, and that should be in a square bracket. So take the value in my momentum column, dot iLock yesterday, so I minus 1. So if that value yesterday is less than 0, and the value today, so data value in my momentum column today, which is .iLock I, is greater than 0, that would be another signal to record. And in this case, we'll put a 2 in our signal column. And then what I'm going to do is just, I'm going to uncomment this now and make this our momentum entry, say. So it's like a positive momentum entry, right? So, and I can't spell today. So we'll call that momentum entry. So we've got our oversold entries and our momentum entries. And then what I'll do is just have to amend this slightly. And we will, can I spell the word? Momentum entries. And then we will, what we'll do is, in fact, I'll just copy all of that. And we'll make that again. So we're looking in our new column for momentum entries, and then I'll make that gold. Right. So all we're doing here, so now we've got our, so when momentum turns positive, we're going to have another long, basically. And so we're putting a 2 in our signal column when that occurs. And then this little function here is looking for a 2 in that signal column. And where it sees it, it's going to return the low minus the little offset. And then it is going to create a new column within our data frame called momentum entries, storing the price where we got the 2 signal. And then this little section here again looks for prices within that momentum entries column and creates a marker where it sees one, which this time is going to be a gold arrow up. So if I go and run all that again, what you should see now is that you're getting more entries, so definitely more to play with now. So we've picked out these string lows, and now we're picking out the times where we've had a bit of a pullback and then we've started to turn higher. So let's go and have a quick look at those. So not always perfect. But you can see like this, for example. So we had a pullback and then we've started to rally a little bit, and it's telling you that you might want to, momentum's turned positive and you might want to get in and look for a quick profit, which is exactly what we're going to do here. So what we're going to do, in fact, I'm going to delete that and copy this section here. Okay, so, and then that will be an LF. So if our signal is 2, if we're short, which we never are, but if we don't have a position already, then we are going to buy with a size of equal to 99% of whatever our available balance is. And what we're going to do is set some stops and profit targets on this one. So I'm going to put a stop loss here at 2%, so 0.98 times that price here. And then I'm going to set a take profit at, I think we did 3.5%. I have not really looked at this massively. You 100% want to play with all of the levels that we've done today. But so I'm going to basically, on our oversold entries, I'm going for a 2% gain. And on our momentum entries, I'm using a 2% stop and a 3.5% profit target. So if I run everything again and have a look at the results, you can see that we're in the market 51% at the time, 52%. We made just under 400%, pretty decent. We have a lower drawdown metric compared to sort of buy and hold over 169 trades. We win 64% of them, just about. Best trade 5%, worst trade 4%. That'll be gaps. And the average trade makes just under 1%. Pretty decent. So not bad at all for a very, very, very simple strategy that you can run yourself and monitor on a daily basis. So let's add a little bit. Bearing in mind, we want a profit and loss, don't we? So I'm just going to grab all of that just to see what our drawdown periods were like. Profit and loss really important because, in fact, let me separate that out because I want to show you. I've forgotten how I do that. Split sell. There we go. So so profit and loss is very important, right? Because you need to know where your drawdowns are coming, or you want to have a look at how your drawdowns occur. Because if they're really nasty drawdown periods where all you do is lose for a year, you're probably going to give up on your strategy before it makes money. So it would be nice to know in advance that this one actually can have really fallow periods, but so let's run that then. So all I'm doing here is taking our trade stats, and if you want to have a look at what that looks like, I'm storing it in a variable called trades, and effectively all that's going to tell you is what your entry bar and exit bar was, entry price and exit price, what your stop loss and take profit was, what your profit and loss was on the trade, how much commission you paid, and then, return percentage, etc., duration, etc., etc. So useful if you want to go and have a look at your individual trades. So that's that. And then the cumulative P&L basically takes the P&L column from within that trades stats there and creates a cumulative sum of the value so that you can have a look at what it would look like. And I'm not going to save the image, so I'm going to get rid of that. But if we run that, you can see it's really nice. Like, it's a really good strategy because you're not really getting tons of nasty, nasty action or nasty periods where you just decline over 6 months. That's a nice that one, because your strategy never really keeps you up at night because it's lost the last 9 trades and your portfolio is down 30% or whatever. So that's a nice P&L. So that's good. That's the first thing. And then let's do a Monte Carlo, and our Monte Carlo does a similar thing. What it does is it takes the trade order and it randomizes it. So this time it looks at the return percentage column within that trades variable here. So Let me just run that again. So it's looking for this column here rather than the actual monetary P&L. And what it does is it takes the order of the return percentage column and it randomizes it 100 times to create its own P&L effectively, and then displays them all on the same graph. So if I now get rid of that, I don't want to save the chart, go and have a look at that. You can see that's a really nice Monte Carlo simulation. So what it's designed to show you is, if all your losing trades came at the start, how would it impact your, your strategy? And in our case, because the P&L is so good and the strategy is so consistent, you're never really getting into much trouble. In fact, the worst one, or the worst simulation here, you were down 13% after your first 15 trades, and then it started to take off again. So with this strategy, mostly you were in profit right from the start and continue to be in profit, even though you didn't beat buy and hold. So given that we didn't beat buy and hold, could you use a bit of leverage? Well, you could probably, but you need to be wary about this, and you'd probably be looking to add in a stop loss before you do. But if you were to use 2-to-1 leverage, obviously all your normal metrics would remain the same. So your drawdown and win rate and everything, but not your draw, the win rate and everything would stay the same, number of trades and all the rest of it. But the drawdown is going to double or more, just about double. So, but if you ran that again and use 2-to-1 leverage on that strategy, your drawdown would move to 47%, and but you would make 2,000% on the market. I would not advise leverage on this particular one, even though I never do. But I think if you're going to do that, you'd want to have a stop loss here. So what could you play with then with this one? Well, obviously the main thing that you'd want to play with is the momentum over time. So we've used 5-day rolling window and then look for extreme points within the momentum, but you could move that out to 8 periods, 9 periods, whatever. Also this part here, you would want to play. So for our oversold entry, what we said was if the Qs have dropped 5% over a 5-day rolling period, that is a good time to get long. You probably would want to play with that, given that you do get buy signals at the lows and everything, but also you get them like here. And this, but bearing in mind that you didn't have a stop on this, this is what kind of kills you. So you've missed all of this and held this position until finally it made a 2% profit, which is probably around here. So that's your worst trade, very likely. So definitely can be played with there. So add in stops. And then obviously for our momentum, you could look at it differently. So I've just done it where negative momentum turns positive. So 5-day rolling window is now positive after being down. And I've used that, but you could change that to, momentum has to change to 1% positive, or when momentum over a 5-day period was -2% and is now only -1%, the turn is in. So you probably get a better entry for that as well. And obviously, bearing in mind that we've got it to work for QQQ, you 100% are going to be able to find stocks that you can use with the same strategy. Obviously, you're going to have to play with stops and profit targets, and probably your sort of extreme readings. But there we go. So I hope you enjoyed that one. If you have any questions, please feel free to email in. It's info@bubble-analytics.com. Have a good one. See you next week. Thanks.